and welcome to this month's Financial Markets Update. Well, November was a solid month for financial market performance. We had both equity and bond markets rallying at the same time, so that was something that we haven't seen for quite a number of months throughout the course of 2022. So very pleasing in the context of seeing that rally. Domestically, equities were up around about 6.5%. This was led by the resources sector, which was up over 14% over the course of November. Global equities were also stronger, up anywhere between 2.5% to 6%, again depending upon $A positioning. The Aussie dollar had one of its strongest months over November, and it was up over 6% for the month alone. And then bond markets, as I said, rallied strongly. We saw lower yields right across the curve in both domestic as well as global bond markets. So that was a really positive backdrop, not only for fixed income markets, but equally obviously for equity markets. So what drove the rally that we saw through November, despite the fact that central banks around the world increased cash rates? We saw the RBA increase domestic cash rates by 25 basis points, so 1/4%. And as we sit here today, they followed that through in its December meeting by a further increase of 1/4%, so 25 basis points, taking the cash rate now here domestically to 3.1%. So that's been an increase of 3% over the course of 2022, and clearly there's more to come if you were reading the commentary from the RBA. But we do believe we are getting closer to the end point as it relates to the tightening cycle here domestically. We do continue to see a peak cycle somewhere in the 3.5 to 3.75 range, and certainly from our perspective, we felt that the RBA could have sat on its hands in its December meeting, given the fact that the economic outlook and the data certainly is continuing to show that the global economy is slowing. In November, we also saw central banks, particularly the US Fed and the ECB, increase their cash rates by a further 0.75%. So central banks haven't taken their foot off the pedal by any stretch of the imagination, but clearly the commentary coming out of central banks is that they are further through their rate tightening cycle, and that future rate rises are going to be potentially more data driven. So read that as less frequent and certainly at a smaller level than what we've seen throughout the course of 2022. But there's no doubt that inflation continues to be a real challenge for not only the domestic but clearly the global economy. And so central banks have continued to reaffirm the view that they will raise rates as far as they need them to go in order to be restrictive, in order to create an ongoing slowdown in economic activity. The risk for not only the domestic but equally the global economy is, does that push the global economy into recession? And that's really the conundrum, I think, facing financial markets at the moment as we head to the back end of calendar year 2022 into 2023. And in our view, we definitely believe that there's going to be a material slowdown, certainly through the first half of 2023, as all of those increases in official cash rates start to bite, whether that be in terms of credit cards or more domestically here, we're seeing a significant amount of loans, bank loans and mortgages shift from fixed rate loans into variable rate loans throughout the course of 2023. And we think that's going to have a big impact on people's spending patterns and the like. Notwithstanding that, unemployment continues to remain sound, and I think that's, again, the biggest saving grace for central banks at this point in time, given the fact that people have a job. If we maintain a low unemployment rate, then that does provide some flexibility in the way that central banks manage official cash rates going forward. And certainly the other challenge around that is that people continue to spend, so the inflationary pressures are likely to remain elevated, certainly through the first half of next year. So the conundrum facing central banks and how investors are trying to position their portfolios accordingly is something that is causing the ongoing market volatility that we're seeing on a month-to-month basis. But as I said, from a financial markets point of view, we think that ultimately markets will start to look through the rate cycle, and as if the economic activity can remain relatively sound, albeit we think it will slow from here, without a significant degradation in the labour market. We think that financial markets are well set for a solid investment return throughout the course of 2023, and predominantly led through the second half of next year. As I said, if the impacts of those rate rises really do bite in the first half of next year. But an interesting market environment, as I said, certainly we expect further rate rises. We certainly saw that, as I said, with the RBA in December. So probably taking a little bit of gloss off the Christmas cheer for many people, and that'll continue throughout the course of 2023. But in our perspective, as I said, we'll see most of that in the first half of next year. From a portfolio standpoint, we haven't materially changed our strategy at all or our asset allocation positioning. We've been, as I said, nuanced around how we're seeing the direction of the rate cycle, how we're seeing economic activity. So we continue to remain relatively cautious on our overall positioning. And we think that that's appropriate, as I said, given that there is still a high degree of uncertainty. Economic growth is expected to slow. And as I said, the rate cycle is yet to peak. So from our perspective, as I said, we've been continue that cautious stance, adjust the asset allocation as we see those opportunities play out. And as I said, when we look through the second half of next year, we think there's a lot more upside for financial markets. Should, as I said, peak rates come about, and we see a global economy where growth starts to, as I said, pick up a little bit more steam. As always, if you have any queries about your portfolios, please feel free to reach out to anyone in the team, and look forward in catching up again next month. Thanks, and bye for now.